And for more insights, let's bring in Thomas Hayes, Chairman and Managing Member at Great Tail Capital. Thanks for your time, Thomas. And it's really all about that inflation data. Traders watching that closely, not a whole lot of movement on Wall Street. What are you looking out for and what are you expecting?
Yeah, tomorrow's a big deal, Sarah. Thanks for having me. Month on month, core PCE is expected to be up 0.4% and year on year 2.8%. We did get some strong inflation numbers earlier this month, so traders are on edge. Chris Waller was out today talking about potentially 3 cuts towards the back half of the year, but we are going to need to see inflation coming down to see that manifest, and the market really wants to see an easier Fed. So as we look forward to tomorrow, we may see some short-term bumpiness, but the trend is down. A lot of the seasonal bumpiness had been around owner's equivalent rent and sticky services inflation. That will work lower as productivity increases and 12-month leases lapse, and we get rid of the lagged effect on leasing strength.
Yeah, when we pull back a little bit, Thomas, you mentioned there that we did get consumer prices, producer prices that were hotter than expected earlier, and expectations are for some pickup in inflation. How vulnerable is the market to a potentially bumpy road ahead for inflation?
Yeah, I think if you look at the non-seasonally adjusted numbers, they're telling a better story. So I think as we look out and we see some of the revisions and we see the numbers, the trend is going to persist towards the 2%, and it's going to persist very quickly, particularly as it relates to the owner's equivalent rent. But as it relates to the Fed, the economy has been surprisingly strong. Even though GDP was revised down just a little bit today, we're still looking at plus 3% in Q1. If you look at the Atlanta Fed GDP now, we just are finishing up an earnings season with over 75% of the companies reporting over 3.2% earnings growth. When we came into this quarter, Sarah, people were looking for just 1% earnings growth. So this is a big beat. And I think we're going to continue to see that strong economy on the back of the strong consumer spending and the productivity gains.
Yeah, you mentioned a strong economy, positive earnings picture. We got a rally on Wall Street. A lot of positives here, and there are a lot of market watchers saying that this is quite a Goldilocks period for the U.S. economy, where it's not too hot, not too cold. Amid all these positive factors, where are the risks, Thomas, and is it time to get a little bit worried?
Yeah, we've been publicly aggressively bullish since fall of 2022. And then again, last year when people got bullish in October 2023, we've been constructive the entire way through. And of late, in the last week or so, we did put a portfolio hedge on about 1% of equity capital because we want to stay fully invested, but we do want to guard against some short-term volatility. In an election year, if you look back to 1928, this period, late February through early April, can be some bumpiness after an early part of the year rally. The seasonality provides for that. The other thing you have to keep in mind is while earnings have been great, we are trading at 20.5 times forward earnings, which is pretty high with interest rates at these levels. So it wouldn't surprise us to get a little short-term pullback. But as it relates to election years, on average, the S&P ends up 11.28%. So even if we do get a little weakness short term, we are very constructive for the year, and we would use any weakness to add to positions for the long term.
And coming off that earnings season, given the rally and your outlook that you mentioned right there, do you expect a pullout or a broadening out of gains on Wall Street? And is there still room to run?
I think that's a really good point. We could see a scenario where what has led the market in the last 9 to 12 months, which has been a concentration of tech in the market cap-weighted indices, starts to stall a little bit. We get a little breather against big tech, and we're starting to see in the last, certainly towards the end of last year, and then a new revival in February of more groups participating. You've seen healthcare which was not loved last year, start to take the reins. Industrials are performing. Even small caps this month started to perform quite well. So you could see maybe some stalling in the indices, but under the surface, the remainder of the companies start to outperform. And because their weights are smaller in the indices, you won't see it in the indices strength, but you could make a lot of money under the surface buying high quality companies that have been on sale for some time.
And real quickly, Thomas, before we let you go, for those who have missed out on the rally so far, where are the opportunities?
Well, I think you want to look at some of the higher quality companies that have been marked down. One of the ones that we loved, which you just talked about, was Disney. That's had a pretty big move in the last handful of weeks on good news. So maybe if on some weakness, you might want to pick up some Disney. The banks have started to move. I think on some weakness, you might pick up some banks. And most importantly is biotech. We own a basket of biotech, just the ETF, which has basically been consolidating sideways for about a year and a half, and it's just now starting to take off. And the theme there is deals and drugs. Risk appetite is coming back on. Big pharma has record cash on their balance sheet. They are now buying these undervalued biotech companies for innovation and for growth. We're going to see more M&A in the biotech space, and more innovative drugs are getting approved, whether GLP-1s, whether stuff related to cancer, Alzheimer's, et cetera. That theme will continue. And the final driver is the Fed starts to ease, which is always very good for risk-on, long-duration assets like biotech.
Yeah, in the meantime, we'll watch the inflation figures when they become available. Thomas, thanks so much for your insights today. Thomas Hayes, they are chairman and managing member at Great Hill Capital.